when you have 1,100 people a week moving to the Tampa Bay area, and you have a 60% home ownership rate, that's about, 400 people who aren't going to buy a house, and where are they going to live? Now, not all of them are going to move into apartments, but I think we're going to continue to see a tremendous demand for apartments and multifamily housing.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, we're in a very tight market.
It's a tight market, and it's a good time to be a landlord because the landlords, for a long time, were not in the driver's seat. Today they are.
They definitely are, and we see rents bump. We do a lot of retail, manage retail, broker retail. A lot of our folks will come to us, and a lot of our clients, and say, buy a property, and then we want to just get a check at the end of the month, whatever the residual is, and we sit down with them and consult with them. And it's never as easy as that, is it, Stephen? In fact, is in terms of, hey, go find me a deal. Man, there's a lot of people out chasing deals. And this is what we talk about when there's a tight market. It's not just on the tenant side, it's also on the buy side. And I don't know how many times I have buyers. We have very lengthy list of buyers. We can't place we can't find deals for everybody that's in our pipeline. It's impossible because we're limited by what's in the market, and there's so many people looking for cash flowing deals. So, we do the best we can, but we'll have new folks, new buyers come all the time and say, hey, find me an apartment complex. I want Class C value add, and I only want to pay 80 cents on the dollar for the property.
And I still am getting them, and I want one that's bank owned.
It's unfortunately, Stephen, I don't have time to educate them. I don't have time to educate them.
The market's changed.
And it's that those deals don't exist anymore. It's short. Yes, we're still doing transactions, but the margins are compressed. The pricing is higher, and trying to find deals at 80 cents on the market. I don't think folks realize when you get something that comes on LoopNet, for example, if it's a good deal, which is pretty rare, you get on LoopNet, it's pretty rare, but there's 3 offers that come in on the same day. And there's just a stack up of people wanting to buy, and it's just not that easy.
But it's also important in today's market, if you're serious about something, to move quickly, because sitting on the fence, somebody else comes in under the fence.
Yeah, there's no doubt. Hey, want to get into our show today because we've got a great episode. We've got a guy who's been on before, giving us a market update. I know you guys will want to hear it because we're going to talk about all the asset classes. We're going to focus on multifamily. Wanted to just quick read a review that we had from AWTPACRE. Says, great content. Eric and Steven always have great guests, and I learn something new every time I listen. Hey, that's the type of stuff we like. We love you guys to go online and give us a review on either iTunes or on the Google Play Store.
Because it helps us get guests.
And if we get guests, it helps you guys with more content that might educate you on taking your next step in your real estate venture. So if you haven't done so already, we definitely would appreciate you going on and giving us a review. It certainly is helpful. Our guests do go and look to see who's out there listening to us, and if it's worth their time to come on our show. So you guys, AWTPACRE, we definitely appreciate you, and anybody else that goes on to give us a review, we would greatly appreciate it. Steven, anything else before we roll with our guest?
Let's roll. Today we have with us David Beshears. David has been involved in the commercial real estate industry for over 30 years. He graduated from Florida State University real estate program and started his career in Tampa with Cushman & Wakefield. He started Beshears and Associates, a commercial real estate valuation practice, in 1994. Over the past 25 years, his firm has appraised over 10,000 commercial properties throughout Florida and the United States. He's a member of the Appraisal Institute and a member of the Royal Chartered Surveyors, also a licensed real estate broker and a state-certified general appraiser in Florida and Georgia. David also teaches the Argus Financial Modeling class every semester in the real estate department at Florida State College of Business. David, welcome back to the Invest Florida show.
Hey guys, great to be here. Great to be here.
Hey, Dave, officially you are a retread, and we're really happy that you're a retread. Back on the show again.
Absolutely.
We appreciate the insight that you have in the market here, and I definitely appreciate the time that you take for our listeners. Today, I think, Stephen, it's probably a good idea just to talk a little bit about what we're going to talk about.
Well, David is in a unique position. You know, normally we talk about a specific topic and we'll do that, but David has such a good overview of what's going on in all aspects of investment real estate. So maybe we could start off talk a little bit about the growth in Florida and where the growth is happening, and then go into talk about some of the categories.
Some of the categories, and we're going to spend a lot of time on multifamily because that is for us, the largest listener base or folks interested in multifamily. So we want to touch on all the asset classes just briefly, but we're going to spend a lot of time on growth in multifamily. So everybody knows what they're getting into, and you know, we're happy to talk about these things. Why don't you talk about? You just put out a piece, Dave, on I-4 corridor. Why don't you give us a little overview on what's happening in the I-4 corridor and what you're seeing?
Yeah, and really, I mean, the growth, and I don't think, you know, we see it every day. You get on I-4, you drive to Orlando, you drive to Sarasota, you see the people, but just put it into sheer numbers. And this all came about because I was at an industry event, and they had some really, really smart guys from New York and Chicago and DC who were talking, and they were kind of talking about, and they were not from the area, and they really hadn't been down here much, and it was kind of interesting to see their viewpoint, but they were kind of like, and they kept on mentioning this, and it was kind of the takeaway that I and several people in the conference got was, hey, if Tampa really does everything right, someday we can be as cool as Raleigh and Austin and Nashville. And that's the cities they kept on talking about. And
Sure.
It kind of got me thinking, because I had just finished our apartment newsletter, and in that we do a projection of what markets we think are going to be saturated, and we use population and employment to make those projections. So I went back and I started looking at what the actual population growth in Florida was, and I used some U.S. Census numbers. Also, Cushman & Wakefield recently put out a great report. If you want to look it up, it's a Florida population report. It's a 10-page PDF that's on the available on the internet. And they did a projection with their economist on what they thought the population growth was going to be in 2019. And so what I did was I put a table together. I said, okay, well, you know, we all know the three fastest growing states in the country are Texas, Florida, California. But if the I-4 corridor, Tampa, Orlando, Daytona, Lakeland, if we were a state, we would be the fourth fastest growing state in the country. According to Cushman, the I-4 corridor, that 145 miles stretch, is going to add 160,000 people in 2019.
Wow.
Now, to put that in perspective, the entire state of California is adding 190,000 people a year. So to also put that in perspective, that's more than the entire Midwestern United States is growing. If you add Jacksonville, which is another 30,000 people, North Florida is growing faster than all of the northeastern states and all the Midwestern states combined, all 20 states, which represents 40% of the population of the U.S. So when you start talking about growth in those parameters, you really start to get a sense of how many people are coming here. Now, the Orlando MSA would be the 8th fastest growing state in and of itself, and Tampa Bay would be the 11th fastest growing state in and of itself. And that's up there with some really states everybody thinks are really fast growing, like North Carolina and Georgia and Arizona. But that's how fast we're growing as a state. And of course, Southeast Florida and Southwest Florida, the southern part of the state, they're growing very quickly too. Our focus was kind of on the I-4 corridor. So, and we see it, I think all of us see it just being out and about, with the roads being stacked up and stuff. But just the sheer number of people moving here, I don't know that we all really have a grasp of how that impacts commercial real estate and how it reflects compared to other parts of the country.
We've heard the term, constantly we hear the term I-4 corridor, and that really denotes everything that runs from Tampa, including Sarasota and the Tampa Bay area, over to I-95. And the coastal communities there. And it's funny that you mentioned Jacksonville. I start hearing Jacksonville be tied in with definition of I-4 corridor as well, because it really is sort of all connected. And one of the terms I heard was the I-4 triangle, I-495 triangle, which included Jacksonville, and was basically from Tampa to Jax. And the reason for that had to do with shipping and transit and the logistics that's going on really in the middle part of the state around, I guess it's around Bartow and Winter Haven, where they're building the terminals that connect up through Jacksonville. And I think that's why they're including those all together, because it's really, when you look at Ocala and what's happening in Lady Lake, and all of that explosion around the villages and whatnot, it's almost seems like, it is sort of a triangle, isn't it?
Well, it is. And if you see the growth, I mean, we see so much growth here. I recently have spent quite a bit of time in Jacksonville, and to see the growth up there is just tremendous. And then, as getting into the smaller cities on the state, Sarasota, Bradenton, Naples, Fort Myers, all of those are growing so fast. But I do think you're making a good point with the interconnectivity between Jacksonville, Orlando, and Tampa. And those three cities, I think, are going to continue to garner a lot of the focus and a lot of where people, because those are also, if you're coming in from out of state or if you're looking to relocate, those not only have a lot of the infrastructure in place, but it's a more affordable place to relocate your business than a South Florida, which has its own dynamics as to why it's growing.
Sure.
So what's interesting is the I-4 corridor has all this growth coming, but just by itself, before all the growth, the I-4 corridor, even politically, is really important to Florida. They say the way the I-4 corridor votes is what determines an election.
The elections, yeah.
Yeah, and even the national election, yes. So I-4 is really, I kind of believe it's kind of the future of the state and, the future of the growth. And again, if you look at it, it's only 145 miles from the Gulf of Mexico to the Atlantic Ocean along I-4. So that really is not that long of a stretch, in that linear population growth. And, and that's about 7 million people in those 4 MSAs. And if you add in Jacksonville, of course, you're bumping up to closer to 9. So you have a lot of people, in that geographic area. And again, I think that's going to garner most of the focus of the growth.
And where do you see the growth happening? Is it, obviously there'll be a lot in distribution. Is that pulling people in? Where are the jobs being located?
Well, I think distribution, manufacturing, some manufacturing, we're getting jobs there. Florida still, I think, has a challenge in trying to get high-paying jobs into the state. That is something that I think we still need to work very hard on. And that kind of gets back to, as we'll discuss, one of the bigger problems in the multifamily sector is the lack of affordable housing. Because so many of our jobs aren't at a pay scale that allows people to pay for the Class A apartments that we're building. Mm-hmm. There's quite a bit of development in industrial space, and that is something interesting in our practice over the past 3 to 5 years. As we've started doing quite a bit of industrial valuation, even on spec big box projects And we hadn't done that since the, early 2000s. There really had not been much of any in the way of industrial development.
Yeah, it's quite interesting. We had Steve McCraney, who's the largest independent developer for industrial in the state, on the show about the same time we had you on a couple of years ago. And he was talking about all of his eggs are going in the I-4 corridor basket because of what's happening with the terminal system there around Winter Haven, and doing million square foot plus projects for everything from FedEx to Coca-Cola to I can't even remember who else he was doing projects for over there, but really large scale stuff. And he was very, very bullish on the area. And all you're doing is putting fuel on the fire. Is the things that Steve talked about, that why his firm and their institutional capital is backing, they're backing projects in this area.
Yeah, and I think we're going to continue to see it. And I think if you looked historically, Florida built a lot of industrial and bulk space in the 80s and in some in the mid 90s. And then it kind of screeched to a halt, and we really weren't seeing it. Orlando saw a lot more of it than the Tampa Bay area did, as the logistics hub kind of shifted further to the east. And so, but now we're starting to see a lot of that, a lot more big box industrial development come in, and we're seeing, obviously, across the board, vacancy rates fall and rental rates on industrial space push up. And that was always the hindrance, obviously, was the rental rates that were being achieved just didn't justify new construction. But now we're seeing that.
Yeah, it's probably a good transition now for us to roll in to talk a little bit about what's happening in industrial, what the cap rates are, and what you're kind of seeing happen there with the rental rates and whatnot.
Well, also one of the reasons that's helping propel this for those who don't listen that often is the Panama Canal is now there'll be large container ships. Previously, they couldn't come through the Panama Canal. All the freight was offloaded on the West Coast, but now that these larger containers can come through, they'll be able to offload in Tampa.
Not Tampa. They're not going to be able to come into Tampa.
I think some can come through, but anyway, definitely Jacksonville and Miami and on the East Coast, some of those large
the super vessels will be on the East Coast, but not on the West Coast. There's no place you're going to be able to offload because the skyway is a problem. But what you're seeing, and this is actually from a report that I just read here a couple months ago, what you're seeing is the backup that's now in Port Everglades and also in Miami is that the secondary ports like Tampa for container they can't help but pick up more traffic. It has to.
Yeah, I have to check that. I'd read that the cruise ships couldn't fit under, but the container ships, the containers can.
We do have containers. We do have a container board here. We just invested in another large crane, but we cannot fit the super the super ships into Tampa because of the Sunshine Skyway and because of the depth of the port. Where they need to, I think they have draft at 75 feet and we're 60 feet or 58 feet or something like that. So there's a number of geological and engineering issues that would prevent us from ever having those large container ships come in. But it doesn't mean we're not beneficiaries of it. The product still has to come to the I-4 corridor, and because these large ships are now clogging up South Florida, this is the smaller ships are being used to
it's become the distribution hub because
correct.
It's central.
Yeah, that's correct. Yeah. So, Dave, let's talk a little bit about industrial and the rent rates and what you're seeing with vacancies and all that good kind of stuff.
Well, I mean, we've seen vacancies fall, and and generally vacancy is below 5% across the market. I think the industry-wide vacancy rate's like at 4.3%. So vacancy is very low. In some markets like Pinellas County, it's even in the 2 to 3% range. And rental rates are, in some markets pushing up as high as $8, $8.50, $9 a foot. So, in those ranges, it certainly becomes profitable to build.
Sure.
And, and again, I mean, our industrial market in the Tampa Bay region is very bifurcated. I mean, the projects that we work on, typically most of the projects over in Pinellas County, as you know, are not bulk distribution. That's not a good location to be a bulk distribution facility because you don't have the linkages over there that you do over on the on the I-4, I-75 corridor. So what you have over in Pinellas County is air-conditioned space, air-conditioned manufacturing space, smaller buildings, anywhere from 20 to 100,000 square feet. But, those are where the small manufacturers, clean manufacturers are. And we're really seeing a push in a demand for that product over there. I probably have appraised like 3 or 4 pharmaceutical manufacturing facilities in Pinellas County in the last year. So that's really kind of becoming a hub for that. And it's really interesting. It's a very specialized industry. And once they get licensed, they have to stay within a 5-mile radius of where they're at. So it kind of, once you get those people in that market and they start getting a hub there, it kind of builds on itself. Obviously out on the east side is where we're seeing the bulk industrial development and along 75. And, that's even moving down. I mean, Benderson's built some bulk down on the 75 corridor down in Sarasota. Typically most of the bulk just went to the east towards Lakeland, and that's where the super huge projects are typically going to be. But, with the growth of the Sarasota, Fort Myers, Naples to the south of us, it's starting to make some sense to put some, 100, 200, 300,000 square foot big boxes down there along 75. And this industrial space is a little different than what they were building before. Now you got to be 28 foot, 30 foot clear heights, and these are big, high cube boxes. So it's a little bit different product. Some of the product that we have is just quite frankly, obsolete because it just doesn't have the clear heights. So that kind of holds back some of it. But I think we will continue to see, I think industrial will continue to be a really strong market because of all the things that you and Stephen just talked about. And although rental rates have pushed up, they're not so high, nor are the banks going to let people go out and build, spec industrial all over the place, like what we were seeing in the mid 80s when there were people like Trammell Crow running around and some of the other big developers who are building spec industrial everywhere. Mm-hmm. We just don't see that. That's just not the environment that we live in today. And so, new development is constrained, and that's why you're seeing vacancy rates, below 5% across the board. There's tremendous demand. It's just, the developers have to have that tenant in hand to go out and build the space before they can get the financing typically.
Right, so I know we want to get to multifamily, but maybe we can just touch on, since we started with industrial, just a little bit about what's going on in the office market, and also, I don't know, maybe retail, if you want to talk about that a little bit. Just touch.
Yeah, we don't need to go in depth on retail and storage and office, but maybe just a couple sentences on each one and get us up to date on what's happening in those markets.
Yeah, and I think retail is a market that kind of gets misaligned, I think, because everybody is seeing the impact of the internet on retail, and you can't deny the impact. I mean, it certainly is there, but people are still making money in retail, and particularly people are making money if, the people who are really having spaces that are hard to fill are the big boxes, obviously. And if you have a big box blowout, that's a lot harder to fill today because those concepts are shrinking, and even the concepts that are still economically viable don't want the same things they wanted. Best Buy is a great example. They no longer want 50,000 square foot boxes, So if you have a big box, it's a former Winn-Dixie or a former Sweet Bay, some of those spaces are still hanging around out there. It's hard to fill those. And we've seen some of those be backfilled into self-storage operations. I've seen car dealerships, take over old Kmart's, that type of thing. So we are seeing that. But if you look at the inline spaces, we see a lot of, that there certainly was some carnage as it switched from an inventory-based retailer where you had the little card shop or you had a little dress shop. And those folks, most of them couldn't compete in the internet world. But now we switched over to a service-based, retail component where you have the nail salons and the massage studios and the restaurants. And so as we've made that shift over, I had one developer tell me, he loves retail, but he makes sure none of his tenants carry inventory. He doesn't want to have a tenant that has inventory because then they can be outpriced by the internet. So So I think, we're seeing the shift in retail. If you've got a power center with 4 big boxes, maybe that's something to be nervous about. But if you've got a smaller retail center with tenants that are service based, I think that market's pretty strong. And generally retail, again, if you're the T-Mobiles and the all the hot Chipotle and all those, you're seeing rental rates that are $60-$65 a foot, crazy numbers. Some of these rental rates that we see on these new centers that we value. But if you're a more mom and pop related tenant, and your rental rates are generally still in the mid-teens, high teens, low 20s. Mm-hmm. You can't build a new center for competition. No. Nobody can build a new center based off of those rental rates. It just doesn't make economic sense with the construction costs. And so the people who have invested in those centers that are a little bit older and they more are service related tenants, they have a great asset there. Mm-hmm. And I think they have an asset that's going to continue to increase in value beyond what the competition is. That all these new centers that have these really high rental rates and brand new beautiful center, but if something happens to that tenant or if their concept changes, look at Starbucks. Starbucks, when we first started doing Starbucks appraisals, they were going in line. Mm-hmm. Now we've been doing Starbucks appraisals for the last 5 years, where Starbucks is going across the street from a very successful store because they want to drive through. Uh-huh. So as these really hot concepts evolve and they change how they're doing business, all of a sudden you may have the greatest, the newest little strip center in town, and you've got the hottest tenant, but all of a sudden the tenant needs a drive-through. They're going to move across the street. Can you backfill that space at the $60 a foot that tenant was paying? So those type of situations, I think are something that have a little more risk to them. They look great, and you've got these long-term leases with these national companies, but trying to backfill that space with those high rents, I think are sometimes problematic. Yep. So not all retailers are out. I mean, I appraised a center not that long ago that had an Office Depot and a Barnes and Noble and a Ruby Tuesdays.
A what?
And Eric doesn't read anymore, so he doesn't remember.
Yeah. And so I'm thinking, okay, well, this is, this is going to be all these tenants. As soon as they're finished with their primary terms, I'm sure they all sign 20-year terms. As soon as they're finished with the primary terms, they're going to be gone. That was kind of my preconception going into it. And I got into it. All of them were in option periods. They were all doing really well, and they were doing well enough to go ahead and exercise their options going forward. So I think, sometimes we have this idea that, if you're an Office Depot or a Barnes and Noble, you're just not making it in this environment. But I think in certain locations, obviously they've had to reformat, retool, shrink their footprint, but people are still going out to those stores and buying. They're just not doing it in the same volume that they were, and they are obviously using the internet, and the internet's going to continue to grow. There's no doubt about that.
So what about office?
Office. I really like office. Again, I like office because office is, by and large, the rental rates are way below what you can build new for. And that's why we haven't seen a new office building in downtown Tampa since 1991. I know Mr. Vinnick's going to remedy that, and he certainly has the capital and the horsepower to get that done. Chaz Bruck and the Riverside Heights projects, they've done that up there around Armature Works. They built the new building up there. But in terms, and we had the buildings built around international plans, but by and large, we haven't seen office built in this market. And you would need to be, everybody bandies about different numbers, but somewhere between $35 and $45 a foot full service in order to make the numbers work and actually get a return on a Class A office building. And so, you're just not seeing, the rental rates are nowhere close to that. And in most suburban markets, the rental rates are in the, low or high teens to the mid 20s. So we're still a long way away from being able to make sense of that. Now, there's build-to-suit activity going on, a lot of stuff in the medical space, and we've done a lot of valuations where, build-to-suit medical offices, that's happening. You know, if a company wants a space done a particular way, obviously, and that gets all into the office space that we were building. You know, when I was a broker back at Cushman and Wakefield in the mid '80s, and they used to tell us, okay, you need 400 square feet per person when you're going out and calling on these law firms. Well, now it's down to 100 feet per person, 125 feet per person. So, you know, that alone shrunk our demand. And over the past 25 years, we have been absorbing that shrinkage of square feet per capita. And that's why we have, and we haven't had the office employment growth here in the Tampa Bay area or in Orlando that some of the other cities have had. But now we're starting to see, we've pretty much squeezed that down about as far as you can. And now we're really starting to see a demand for office. And again, I think people who buy into that, I really like the properties that were built in the mid '80s. You know, because that's mostly the new inventory. There wasn't a whole lot built in the '90s, and there wasn't a whole lot built in the 2000s. So generally, the mid '80s represent kind of the newer Class B stuff, and a lot of that's really, you know, well located product. The one, you know, thing that you really have to look at there is parking, you know, and because if that was built for 400 square feet per person and now we're 100 square feet per person, do you have the parking there? But a lot of that product is still trading at 50, 60% of what it would cost to replace it. And so I still think there's a lot of play in the suburban Class B office space. And you know, particularly as the economy is improving and people are going out and starting businesses, and they want to have a place to go. And we've seen a big growth in the executive suite space, you know, for a lot of these little offices. And you no longer, you know, 20 years ago, you had to have an administrative person, you had to have a copier, you had to have a phone system, you had to have all that stuff. Nowadays, you don't have to have any of that. They just have to have a little office, and they're good to go. Everything else that they can provide for themselves.
So and everyone's on cell phones. They don't even need phones.
And everybody's on cell phones. So nobody needs that whole suite of services. So, you know, I'm a big believer in that Class B suburban space, and I think I've seen a lot of investors be very successful in buying that product. You know, so a lot of times in the low $100 a foot range, you know, putting $10, $20, $30 a foot in it, and really making it, you know, really getting a value add there. And so, you know, to me, that market is one of the markets. It probably was the last market to come out of the crash, and I think it's probably the one that has gotten a lot of you know, interest from investors here in the last year or two. But I still think there's a lot of runway there. And the big thing is just, is the building functionally, is it functional in terms of parking and power and that type of thing. But if it is, then I really like that space.
Okay, so talking of spaces that you like, everywhere I look around, and I'm just curious as to your take on it, is I see new self-storage going up, and of course the concept's different. If you could just give us like just a couple of sentences on what you think about that market and where it's headed.
Well, I think generally, and that's, you know, the last time we really delved into the self-storage market was about this time in 2017. I think that was the last time I was in the program, and we're working right now on our self-storage newsletter. And we try to go in and look at, you know, the projects that have come online and what the demand is going to be, you know, for that. I think everybody jumped into the self-storage market because there was such a huge, people were making so much money at it, and there was such a demand, and people were building and filling things up pretty quickly. We are still doing appraisals on self-storage, on new proposed self-storage facilities. We did 3 last month. So they're still being built. You know, and we've appraised 150 self-storage facilities over the last 3 years. So it's been a very active market for us. I think generally the lenders have a fear at this point that we're overbuilt. And so I think there's been a pause. And I think generally a lot of people, you know, we got a lot more requests to do feasibility studies now to really test the market. And, you know, about half of them are feasible and half of them aren't, and it's not because the project isn't feasible. What we find out when we do a feasibility study, generally, I'm simplifying, but, you know, everything in the market is 98% occupied, but there's 4 new projects coming online within a 3-mile radius. And so it's kind of like, you know, we have so much new product coming online that I think we're going to need to take a pause in the self-storage market for a little while. There's still going to be pockets where you can build, and single-family rooftops really drive the self-storage market. So in the areas where you're seeing a lot of new single-family development go in, there's going to continue to be demand for self-storage. I mean, I think there's always kind of a misnomer in the industry that, you follow the apartments, but really, and we do look at apartment growth, when we look at the demand curve for these things, but it's really the single-family, development that really pushes the self-storage side of the business. And so I think what we're going to see with self-storage is kind of a lull a little bit in new construction activity. We're still seeing really, really high demand from investors to buy the product, but I think we're going to see a little bit of a lull in construction activity and let things catch up. I mean, again, we get back to what we talked about at the first, which is when you have 1,100 people a week moving into the Tampa Bay area, that can make up for a lot of overbuilding pretty quickly. So we have a luxury right now of having all these people move in, and as long as we don't get crazy, and I don't think the lending environment is going to let us get crazy, I think any oversupply will be a short-term issue, as long as we continue to have this growth.
Okay, so let's talk about all these people moving in. Maybe you can just touch on the big kahuna, the
what everybody's been waiting for, the multifamily.
Yeah. Yeah, multifamily. And again, I mean, I think that's a market everybody's kind of concerned about. There's just too much multifamily. There's too much coming in. And, I think one thing people forget, and I have the numbers in front of me. We talked about it last time I was on, was, in 2012, we had fewer apartment units in the state of Florida, not percentage-wise. We had total fewer apartment units than we did in 2004. And that was because, as you guys remember, in the early 2000s, what was happening? All the Class A apartments were being converted to condominiums and sold off. And then there was no new construction of apartments going on because there was such a demand for townhouses and condominiums that all of the apartment land, multifamily land, was not being built for for-rent product. It was being built for condos and apartments. So we actually had a smaller, we had a much larger population, we had less units. And it took us until 2012 just to get back to the same number of units that we had in 2004. So as we've seen this huge upshift of new apartment development, some of it was just catch up, to kind of get us back to where we were. I do think, people should be legitimately cautious that we shouldn't build too many units. And it does seem like everywhere you look, there's an apartment complex going up. But generally, the vacancy rates, have been very, very steady. I mean, Class A has ticked up a little bit now. But the Class B and C is still below 5%. Class A is still below 8%, which is expected in a high growth market. And, one of the things that was really interesting to me when we looked at the apartment market is you understand when you start looking at the numbers, and I've heard this from my, investor clients, particularly the guys who've been doing this, for a long time, and they're like, I just don't understand how it makes any sense what these guys are paying, for these apartments. But, in 2009, the average Class A apartment unit sold for $59,000 a unit, and that was at the bottom of the market. I mean, that was kind of at the low point. In 2018, the average Class A apartment sold for $183,000 a unit. So that's a multiple of 3 over that 9-year time period. That's a 13.3% annualized return. So every year, you're getting this great return, and we're continuing to see rental rates go up. We're seeing vacancy rates stay flat. We're seeing cap rates get more compressed. And really in the Class B and C markets, we saw that as well. I mean, it wasn't as pronounced, but Class B kind of doubled from 51,000 to 109,000, and Class C went from 36,000 to 81,000. So, if you have owned apartments over the last 9 years, that's been a great place to be. I think there's a sense by a lot of people that, now's a bad time to jump into it because you're kind of at the top of the market. But my thought on that is when you have 1,100 people a week moving to the Tampa Bay area, and you have a 60% home ownership rate. That's about 400 people who aren't going to buy a house, and where are they going to live? Now, not all of them are going to buy apartments or going to move into apartments, but I think we're going to continue to see a tremendous demand for apartments and multifamily housing. And while the institutions are all real busy on the Class A product, I just see huge opportunity in the Class B and C product, because that really, to me, is the market that's the most underserved. People moving in this market, not everybody can afford to pay, those big rents for the Class A space. And so I think, that's really where we have the biggest shortage of product is in the Class B and C space.
Talk to us about cap rates. Where are we with cap rates?
Cap rates for Class A space is averaging about 5.25. Class B is 6.25, and Class C is about 6.5. So, those are pretty good. Now, cap rates are subjective, and this is what we always get into,
of course,
when we're doing appraisals, because when we appraise it for the bank, we do it the correct way. We add in reserves, and we juice up the real estate taxes, and we put in vacancy, and we put a management fee in, and we really goose it up. And generally, I like to see, on most of the Class B and C product, a 45 to 50% expense ratio as a percentage of effective gross revenue. It's lower for Class A. Obviously, you're going to be in the 30 to 35% for Class A. But to me, if when you really effectively underwrite these cap rates, that's when you start getting these low cap rates. But you've really taken into account the expenses. I still see people out there saying, "Oh, I bought this for an 8 cap." Well, you did, but you bought it on last year's taxes. And you don't have the reserves. So when you start really building in everything that you need to have built into that to properly underwrite the properties, the cap rates are pretty low. But but the flip side of that is, we're still seeing the annual appreciation, and we're seeing financing costs stay low. So overall, even though those rates seem really low, it still has been a good asset class in terms of investment.
So what's the prognosis? Do you think we should stay in Florida now? There's still some more growth coming. Because I saw Eric like packing his bag. He was going to load up a boat. I wasn't sure.
I tell, because I have 4 kids, and I'm like, I make my living in the commercial real estate industry, and I said, I think that we're going to see growth for the rest of my lifetime. I don't know if we're going to want to live here in 40 years. Are we going to have the same problems that California does? I hope not. In terms of just the congestion and lack of infrastructure, but I don't see the growth stopping. And there's some schools of thought that if we have, I know people continue to talk about a recession. I think number one, all of us think recession, and we think what we went through in 2008 to 2011, and that was the perfect storm recession. That was a horrible recession. And I think if we go through a recession, it's not going to be anywhere close to that. But number two, there's some school of thought that if there's a mild recession, it may actually speed up the growth of Florida, because you'll have people who are fleeing some of the Northeast and Midwest, and if they get laid off up there and they were going to move down here anyway, they may just go ahead and make the move. So I don't see our growth rate slowing down without some out of the box black swan event. I really don't see the growth rate slowing down, and now we're starting to get into the baby boom generation retiring and moving down. And so, I just see us continuing to have this growth, and I think the struggle for the our state leaders is going to be to find ways to catch up with the infrastructure and stay up to date with infrastructure.
Yep.
And we all suffer from that right now, when we get out in the interstate. And then also, get back to, once again, affordable housing is going to continue to be something that really plagues us as we move forward, because not everybody who moves here is buying a house. Not everybody who moves here is buying a $1 million beachfront condo. We still have a large percentage of people who come down here to work in the services industries, to work in all the industries that support the reason people come to Florida, and they are not making typically the salaries that they can afford those Class A apartments. And so that's also going to be a struggle for us in terms of making sure in the municipalities to make sure we have workforce housing.
Yeah, it's not new for congested areas, growing areas, that the value of land continues to increase, and we've also got the double whammy of construction price increase. It makes it really hard to try to build now in this environment the workforce housing that's needed to keep up with demand.
Sure, because you got the concrete's the same. You got the high costs, and that's why everybody's almost forced to go with the luxury.
Yeah. Exactly.
Well, they are. And, and I was recently involved in underwriting a deal, and it was specifically geared towards people at the very, lowest end of the economic scale, the ones who are in risk of being homeless. And it was a state grant and all that. But when we got into the numbers, there was no difference on a price per unit basis, than what Class A was.
Yeah.
And part of that is because they have a higher turnover rate and stuff. They build them out of concrete and they build them a little bit stouter. But overall, the cost is the same. Stephen's point, the cost is the same, and so it really makes it hard to build that product that And so that's where the tax incentives in some of the opportunity zones, which is something I'm just starting to get my hands around a little bit. And the CRAs. All of those are going to have to come into play in order to allow people to do some workforce housing. We just did a project out in Sebring that was that checked all the boxes, because it was a National Historic property. They were getting credits for that. They were getting credits from the CRA. They were getting credits for providing workforce housing. And you put all that together, it made sense. But the developer still wasn't going to be getting rich, but it made sense. But it never would have made sense, if it would never have gotten off the ground, without all of those incentives to make that project work.
We're talking about I-4 corridor, but I would open the box here for the entire state, or maybe even Georgia. I mean, although we don't like Georgia, we like Florida.
Yeah, we're going to put up a wall on the northern border.
I know you went to Florida State. I went to Florida, so I can make the Georgia jokes, and people should be able to understand it without melting like a snowflake. But talk to us about apartments. Like, what area that you look at and you go, "Wow, that's kind of interesting." Like, maybe it's surprising good or surprising bad, but you think might be either an opportunity or maybe people are stepping in it.
That's a great question.
How about just activity that you think's kind of shocking?
I'm always cautious when I see apartments going up and there's cows next to them. I'm always cautious when I see that because I'm kind of like, well, there's no limit to how many apartment complexes that can be built around you here. And so, so I always like infill locations in terms of apartments. That gets back to the whole pricing model.
Uh-huh.
And we recently did an apartment complex, out on I-4. And when we got into it, it was a plant city apartment complex, beautiful new project. And it was serving people. And what the property manager told me was, we don't really have and there was no competition around there. There was no competition. They were full. They had a waiting list, and they had people who were they had couples, and one would work in Orlando and one would work in Tampa, and they'd pick Plant City as kind of an in-between location. So, I do think there's opportunities, just like the project we did out in Sebring. I mean, Sebring has all these, because it's a regional medical hub, it has all these people, these young professionals who make good money moving into the market to work in this regional medical facility, and there's no place for them to live. And so, I think everybody has a focus on South Tampa and downtown St. Petersburg and West Shore and in all these markets, but I think that, there are other areas that have employment drivers and they are very short on housing. A couple of years ago, we did a project with a developer over in the Largo market. It was the same thing. I mean, there's just no new Class A apartment projects in Largo. But there's all these businesses, and what you found when you peel back the onion a little bit was everybody was driving in to work in Largo because there was no Class A apartments there. So people don't think of that market as being an apartment market or a bedroom area. It's a place to go work. But once somebody dropped a nice place in that market, it filled up immediately. So I think that's maybe an area that people need to kind of look at as where are we growing? Where's the employment center? Where are the jobs going? And not just, everybody always focuses on the Channel side in the South Tampa markets. And it's hard to go wrong there because of the track records those have had. But I think you have some underserved markets, some of the smaller cities, the Plant Cities, the Lakelands and stuff, that have this employment growth, and they have these people, young professionals making good money, and there's no product for them to live in. Mm-hmm. So I think that there is I think you're going to see people move out into that. I mean, we've seen the student housing market was hot for a number of years, and most of those markets have gotten overbuilt at this point. So now those guys are trying to find another place to rest. And so I think you might start seeing some of those guys move into some of these smaller markets and build projects to attract those folks. The other place that we're going to see, and we've actually looked at this on a couple of projects, is apartment projects near these large residential communities that are really geared towards grandma and grandpa who live out of state, but they want to be close and be able to see the grandkids on a regular basis, but they don't want to buy a second house or a third house in some cases. And so they want to rent a nice apartment complex. And so those are all limited in the demand, but I think you start seeing some of those little sub-markets get filled in.
I hear you. Well, Dave, as always, you've been a great source of information. We're happy to chat with you because you're so full of knowledge. We want to direct people to your site. And so if you wouldn't mind giving that information and also let people know they've got the ability to be able to receive your newsletters, which also are fountains of information. I think they can get from your website as well.
Absolutely. Yeah. You can get my newsletter from the website, and you can sign up for the newsletter, and that is www.beshears.net, and Beshears, Beshears. So Beshears.net. If you Google me and put Tampa appraiser and something that's close to my name, I'll probably come up. So, so that's, we'd love to send it out. We got about 7,500 people on the mailing list right now. We'd be happy to grow that. And so please feel free to go to the site and sign up.
Well, David, we appreciate the perspective and the role you play really in our commercial real estate community. So thank you for being with us today.
Okay. Thanks a lot, guys.
Thanks, Dave.
Okay. Take care.
And that was David Beshears. Stephen, as always, we've had Dave on the show before. He is just a wealth of information, and really lucky to have the connection with him to be able to provide us with information, our listeners information on what's going on in the market.
Yep. I mean, David has his boots on the ground, so it's not just some report. He's seeing it, he's touching it, he's feeling it. So, listening to him, we get a good overview of what's really going on in the market.
Yeah. And I mean, he's not doing a residential appraisal today, and tomorrow he's doing owner occupied. He's doing mostly investment related properties here. And so he's really able to give us some sound background on what's happening and some data that's going on in the investment market in our community. And he does it all over the state too. So, I mean, we talked a lot about the I-4 today, but Dave, if you're wanting to, if you're needing somebody that can do outside of the area, I mean, he does everything from Naples up to Tallahassee to South Florida. So he's all over the place and very, very knowledgeable about what's happening in the state of Florida.
Yeah. And I thought David made one really good point, that what he really said is that the high growth covers a lot of sins. I mean, people are worried about making investments, but your downside is protected by the population growth.
Yep, no doubt about it. So, Stephen, Dave was a great guest. Where can we find other great guests?
The place to go is www.investfloridashow.com. That's our website. Also, download the app on iTunes or Google and listen while you're mobile.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.